Welcome, everybody, to our Leading Startups in Times of Crisis webinar and podcast. We are very privileged today to have Tim Connors with us, and I will tell you a little bit more about Tim in just a minute. But as we do here at Notre Dame, we like to start off our meetings with a prayer. And so if we can, let us pray, and I will offer a prayer. Dear Father in heaven, we're grateful for this beautiful day today, thankful for the blessings that we enjoy. We're grateful for this time that we have to spend with Tim today, and grateful for his knowledge and willingness to share with us. Grateful to be associated with this great university of Notre Dame and the opportunity to work to do good in the world. And we're mindful of so many who are struggling during this deadly pandemic, and we ask for thy blessings to be upon them, that watch over and take care of them, and help us also to find ways to serve and to do good and to help others around us. Again, we thank thee for all that we have, and we pray that thy guidance would be upon us, and through and in the name of thy Son, Jesus Christ. Amen. Okay, very excited today. My name is Brian Ritchie. I'm the Vice President, and Kathy and John Martin, Associate Provost for Innovation at the Idea Center at the University of Notre Dame. Before we start, I'd like to take just a minute and explain how our webinar will work. First, because this is a webinar, neither the speakers nor the other attendees will be able to hear or see you. If you have any questions for either Tim or myself, you can ask them using the Q&A feature within the Zoom app, and we'll devote time during the second half of the webinar to those questions. For those of you that are not aware of the Idea Center, let me quickly take a minute and tell you a little bit about it. The Idea Center was formed 3 years ago as a mechanism, as a center to commercialize technologies that were developed and discovered at the University of Notre Dame. And those might come from faculty, they could come from staff, students, also from the community and from alums. The big focus of the Idea Center is to help these founders and innovators and entrepreneurs and inventors to have impact in the world. And this really fits with the mission of the University of Notre Dame, is to do good in the world, as most of you know. And the mission of the Idea Center is to unlock those discoveries and to fuel that genius and really advance the common good. As I mentioned before, we're incredibly fortunate today to have with us Tim Connors. Tim is the founder and general partner at PivotNorth Capital, an early-stage software-focused venture capital firm based in Menlo Park, California. He's been part of 3 billion-dollar exits. If any of you know this industry, you know that to be a part of one is a big accomplishment. To be a part of 3 is amazing. And just this year, Tim was named as one of the top 100 VCs in the world on the Midas list. So congratulations, Tim. What a great achievement.
Thank you.
Prior to founding PivotNorth, Tim apprenticed for 12 years at Sequoia Capital and USVP. And during Tim's operating career, he helped build C-Cube from a startup into a publicly traded leader in digital video. And at Tandem was the youngest member of an elite design team that built Tandem's flagship Everest server line. Tim received a bachelor's degree in electrical engineering from the University of Notre Dame, and a master's degree in electrical and computer engineering from Stanford University, and an MBA from Harvard Business School. And of those 3 elite universities, we know which one is the best. So glad to have you here and on that.
Spent a lot of money on tuition.
Yeah, that's a great resume. That's a very impressive resume, but we know it all started at Our Lady's University. So that's very excited to be part of that. Let's get started, Tim. You've got a huge portfolio of companies across multiple funds. And like most people, I'm sure this pandemic caught you and a lot of your CEOs by surprise. Really difficult issues happening. What do you think are the big issues that are facing founders and VCs at this point in time? How would you categorize them, and how have you responded to them?
Yeah, I think for starters, the biggest thing is nobody's ever seen anything like this before. No recession in the time frame when VC's been around has ever been this stark, where you had just a booming economy and then all of a sudden everything gets shut down. So nobody's ever seen it before. So first thing is to realize nobody has the answers. And, biggest thing in recessionary times is just to try to stay as calm as you can as a founder and as a CEO. the team will trigger off of your mental mindset. So the more you stay calm, the more your team can stay calm. Fear in a Notre Dame quarterback or fear in a founder has the same effect. It doesn't lead to great execution. So you just got to stay calm and try to be as patient as you can with everybody, and try to be as frugal as you can in how you think about the next few quarters, since we don't really know what's going to happen in this time frame. The good news is the best companies are built in recessions. This unemployment rate is trending towards depression versus recession. The Fed's trying to do everything they can to keep it up and keep it out of depression. But the best companies, as hard as these times are built during these times.
I love how you said, oh, sorry, I didn't mean to talk over you. Sorry.
Go ahead.
No, I just love how you said, be calm, be patient. Best companies are built in recessionary periods. But what if I'm a founder and I was just about ready to raise money, or I needed to go raise money, and then this all happens? How do you counsel them? You think about bridge funding versus, rounds of funding versus how do I make my runway last longer? How are you thinking about this, and what are you saying to your founders right now?
Yeah. So the first thing is, cash. It's all about cash. So 3 months ago, before everything shut down, it was all about growth, responsible growth, hopefully, but about growth and revenue growth. And right now it's about cash. So the question is, how do you best operate the business to end the year with as much of the cash balance you had at the beginning of the shutdown as you can? That's by far and away the most important thing in this time, given that we don't know whether it's going to be a V or a U or an L. So, there's a bunch of components of that on the cash side. One you can control is your burn rate.
Mm-hmm.
So, I always coach my founders to be frugal, but especially now more than ever. So, some of the companies, some of the startups that didn't follow that advice in Silicon Valley are laying off massive numbers of people. But in most cases, there's zero layoffs to somewhere between 10 and 15% of folks. So as hard as it is to do layoffs, it's if there's any excess labor in the team, you really got to be smart about making sure you extend your runway as long as you can. And then salaries, most of my companies have cut salaries somewhere between 15 and 25%, with exceptions for where a certain person on the team has had a unique case or a special situation. The post-COVID new hire salaries are probably going to be 15 to 25% less than they were before COVID. So it's a little bit of sleeves off the vest. But most of my companies are giving a little bit of equity in exchange for taking those salary cuts for now until things get back going again. And so that combination will, typically put you at about, 60 to 70% of your prior burn rate. And that part you can control. Then it's about revenue. And some of this is in your control and some of it isn't. So kind of two parts to revenue. You have your existing customers. Hopefully you have a subscription company with recurring revenue. And then what my portfolio companies have been doing is kind of taking the existing customer list and putting it into two buckets. Which customer is in an essential industry and which ones are non-essential. And then really focus your customer support efforts on the essential industry customers. And then you just pray a lot that they'll pay their invoices when they come in. You don't know for sure, but you hope. And what we're seeing is some of the essential industry customers are actually growing pretty nicely. And it's been super hit or miss on the non-essential side.
Right.
And then that's your existing customer base. And then for your new customer focus, a lot of teams are skinnying down pretty hard on sales and marketing, making sure you only have the most productive members of your sales team going forward. And there you want to kind of take your potential pipeline and focus it as much as you possibly can on essential industry customers, as far as you can in your company. Some companies are just holding on to their chair for dear life. I've got one company in travel. There is nothing happening in travel, and there probably won't be for quite a while here. So, they skinny down they probably at 1/3 of their pre-COVID burn rate, and they're just doing everything they can to extend runway as much as possible. The other thing that teams are doing is, where do you spend your OpEx right now? So pre-COVID, you had a pretty good balance of spend on sales and marketing growth and on R&D. Now we've skinny down the R&D team slightly, but most of my companies have effectively doubled the deliverables on the plate of the R&D team. So trying to get twice as much done with a slightly smaller team, and trying to produce as much product as possible so that when you come out of COVID, you got a lot more product to sell and a lot more ROI to deliver. So some of that is in your control, some of it's not.
Right.
But the more you skinny down and the more you give yourself more time, then you'll be in better shape, whether it's a V or an L or a U-shaped recovery.
Yeah. Let me ask you a two-part question here, and maybe these are a little bit unrelated, but it feels to me like what you're saying is there's not really a standard kind of runway that you're advising your CEOs. You're not saying to them, hey, you got to have 12 months to get through this thing, as much as it might vary by type of industry, type of business, what the customers are doing. Although, as you mentioned, which is a little bit scary, is whether even your good customers will be able to pay. Even places like governments might have real challenges paying as they go forward. So interested in that, but also interested in hearing you say, if I really do need to raise money, what are you seeing right now? Are they, have the terms changed? Are the valuations coming down? Is there money to even be had at all? What would I do if I'm like, man, I've skinnied down to 1/3 and I've still only got 3 months? I got to get some cash. What would you say?
Yeah, well, founders should always be fundraising. So here, startups are always for sale and founders are always fundraising as a general rule of thumb. So if you can get away with not needing to raise now, wonderful. If you have anything less than 9 months of runway, you got to be beating the bushes for funding. I would say for about the first 6 weeks of shutdown, probably 0 to 1% of VCs were out there investing. It's come back nicely in the last 2 to 3 weeks. I've got a handful of companies that have short runways, so they're out fundraising, and the VCs are starting to come back and getting organized and learning how to do a deal over Zoom where they've never met the founder in person. So there's money out there to be had. Angel investors are still very active, a number of them, and some of the corporates are actually active as well. Some are shut down. But some are pretty active as well. So there's plenty of folks out there. The biggest thing right now, the buyers have all the power and all the leverage.
So the terms are probably changing then.
Yeah. So if you can get away with adding on to your last round, so hopefully you raised your last round and you made some milestones and made some progress, you're pretty fortunate if you can add on to the last round versus trying to get something much higher. So I wouldn't be hopefully you can stay away. There's some folks trying to talk about doing weird terms, pay to plays, and weird liquidation preferences and things. But if you can keep it nice and clean, but add on to the last round, I wouldn't turn down money that was available now that wanted to come in. If you're on the shorter end of the runway side. If you have more runway and the terms are onerous, or you don't like the partner that's coming to the table, then you can, I think things are starting to come back a little bit on the venture side. So I think it'll get better in the months ahead as things, we've got a pretty big test going on right now with, I think it's now 33 red states. Seems like all the red states are opening up and all the blue states are extending. I'm sure that's unrelated to the presidential election in 6 months.
Right.
So we have a big experiment running right now in 33 states. And we'll know in a month or two what the implication of that is, whether we're heading to V or U or L.
And do you have an expectation on that, Tim? When you say V, L, U, how long do you think it's going to be? How do you plan in these? in this incredibly uncertain environment, right? What do you think it looks like?
Yeah, you plan for the worst, and then you're not a startup founder or VC if you're not an optimist.
Right.
So when I look at the data out of New York with 31% looking like they've had it, and the data out of Sweden, I'm cautiously optimistic that this reopening will not overrun the hospitals. And if we have success over the next 30, 60 days, and I think everything starts to get back to business, it'll be a while before the airlines and others are anywhere close to back to normal because of human fear dynamics. But if manufacturing can get back, and some of the service industries can get back, and housing construction can get back, a lot of stuff starts to work again. So optimistic that things look a lot more normal in the fall timeframe, but not planning for that in my companies. For now, we're assuming it's going to be, till Q1 with a vaccine, and trying to make, we're trading off growth rate big time for retaining as much cash as possible by year end. And then we monitor every 30 days, and if something changes, we'll get aggressive again. But right now, you want to make sure you got plenty of runway.
Yeah, absolutely. Let me ask you this. You going back to one of the things you said at the very beginning. Stay calm. Take a look around and see what's happening. Certainly, cash is really critical, but you implied that maybe there are some opportunities. The best companies get built in downturns. What kind of opportunities are you seeing? If I were the CEO of a company that you had invested in, what would you be telling me in terms of what kind of opportunities should I be looking for to try to accomplish?
Yeah, it's an awesome time right now if you're super early stage and you're in the mode of building product and making your first few customers happy. That's awesome. Because what happens in these downturns is the smartest, kind of the founders with smarts, goodness, and grit. If you overexpress for all three, these are the best times. So smarts, you got to learn faster than your competition. Grit, when the going gets tough, do you quit? Do the legs keep driving? And then goodness, do you have the empathy and self-awareness to really understand what your customers' needs are to serve them best? And then do you have a moral compass that shows through to your customers and your team so that they stick with you through these hard times? There's a lot of in the boom. Anytime there's a boom, there's a lot of sort of Johnny-come-latelys that show up that sort of play startup, but don't really have the smarts, goodness, and grit. So good time for real founders to build right now. So the earlier stage you are, and the more you're building product and making your first customers happy, awesome. So standard metrics. Do you have happy customers? So do you have a high net promoter score in your early customers? Do your early customers come back often? So hopefully you have recurring revenue wherever possible, and really high retention and retention asymptotes on the metric side. And then do you have good unit economics? So can you sell a customer where they pay much more than it costs you to reach them? So it's a phenomenal time for early stage startups to just be honing in on all three of those key metric areas, so that you can come out of this with where there's a lot of pent up demand, but you've got kind of all the things you can control in place. The bigger the companies are, the harder it is to pivot or to shift around. I think the biggest thing right now is you really need to be a need to have company versus a nice to have company. In up markets and up times, you can sort of sometimes do a startup where the product you're making is not really critical to anybody. In these times, it really has to be critical. So there's for example, I've got a company that delivers groceries with prepared meals to homes. It's called Sunbasket, and their revenue's doubled in 6 weeks. They can't bring on employees fast enough to handle it. Right. Awesome. I've got a company that does mental health services over text messaging called X2.ai. They are flooded with demand in this uncertain time of people having lots of mental health issues. And since there's less bidders on Facebook right now, the cost of customer acquisition has gone down dramatically. So our unit economics are wonderful. So we're doubling down as fast as we can
Mhm.
to help all those people in need. Right, that's a need to have company versus a nice to have company. So it's sort of thinking about the things you're doing that are critical. If you're in the if you make software for helping retailers do online commerce, you're loving life right now.
Great shape. Yep.
If you're in travel, man, you're bumming. It's how do you stay alive
Yeah.
as long as you possibly can. So it depends a lot on the industry you're in, but the more really think hard about, how necessary are your customers and how necessary are you to your customers. In general, that's a wise thing to do anyway, but especially it's true. It's true now. I've got a company called Get Labs that's turning on the ability to get testing, all kinds of different lab tests done in your home or office. And that's been fascinating because we got started about a year ago. We're just about ready to go to market, and then COVID happened. And now for the next year or 2 years, it's going to be just a massive boom market for those folks.
Yeah.
As lots of testing needs to be done additionally, and then lots of COVID and antibody testing has to be done. So they're kind of drinking from the fire hose, right away. So it's in the case of Sunbasket, you could almost argue it was more of a nice to have before, and now it's a critical need to have for people. So sometimes you get lucky with dynamics of what's going on in the markets. On the one hand, we're hoping this ends quickly for companies like Sunbasket. We hope it's the new normal where folks get used to the service and stay.
I love that. I love that you said and we hear this a lot, right? It's good to be lucky in some cases, or blessed, however you want to look at this. But it's interesting how when the economy transitions like this, it creates a whole new set of winners and a whole new set of losers. And to be in the right place at the right time is certainly a great thing. And I'm sure in your portfolio, you've got a few that are in the right place at the right time and a few that aren't. And like you said, travel versus Sunbasket. How do you manage the investor relations across all the partners? If I'm a founder and I've got investors who are expecting me to be, let's say, break even by the end of the year, and now that's going to get pushed out, or another that might have been like, wow, we were just hoping to get break even, and now we're multiplying it 2, 3, 4x, and I've got to manage growth during this period of time. How do you manage those relationships as a founder to the investor?
It's so complex right now. It's hard in general to keep a bunch of different investors on the same page anyway. Especially now, it's really hard. So, really, hopefully you've got a good lead seed round investor who has good relationships with the other additional investors on your cap table and on your board, so they can and put them to work helping you manage the syndicate. Founders, just like if a Notre Dame quarterback gets fearful, it's not a good thing. If the offensive coordinator is anxious and screaming at the quarterback, it's only worse.
Right.
And unfortunately, all too often in startups, a CEO is having to calm down the investor base versus the other way around. So what I always try to do, it's human nature, so it's you're not always perfect at it, but when you're feeling anxious as an investor, it means your founder is nervous as a cat.
Mm-hmm.
So when you're sensing anxiety, you want to try to not translate that anxiety onto the founder. You want to try to cheerlead a little bit. And when a founder is overly confident and just assuming everything's going to be perfect, then you want to be in the mode of being a little more skeptical and a little more tough love. Too often, and you learn this, every investor learns this over time, but it's easy when you're anxious to start peppering the founder with all kinds of anxiety. And sometimes it's the best thing just to put your arm around them and say, hey, I'm here to help. How can I be helpful?
Yeah.
And if you can cheerlead when you're feeling anxious, it can help a lot in these times. But I probably spend a third of my time right now helping my founders keep their syndicates both highly communicated with, and also making sure, trying to work hard to get everybody, to keep everybody on the same page. It's a major challenge anyway, but it's particularly difficult right now.
Yeah, I imagine the anxiety is going through the roof.
Yeah.
Let me ask one other quick question. Are there any of your companies that are looking at this as a hiring opportunity? You know, and before this crisis, there was such a shortage of technical talent, especially, and especially in Silicon Valley, but all over. And it seems like maybe some of those resources might be coming available. Are you encouraging anyone to look out and scoop some of that up?
Yeah, it's not quite yet, a little bit, but not quite yet. Some of the early stage companies that have been funded in the last year or so have key hires that they need to make. And suddenly that's a lot easier and salary expectations are a lot more rational. Um, there's companies like Sunbasket who are just growing aggressively on the food production side, but we're trying to keep things as tight as possible on the OpEx side, not knowing how long this is going to last. But I think as soon as we start to see signs that the reopening is looking good versus going to cause a massive re-shutdown, if that starts to look good, then you'll see a bunch of startups with some latent hiring needs that'll be coming back to market heavily. When big companies like Lyft and Uber are laying off 15-20%, there's a lot of talent freeing up um, with those moves. So, but nobody's getting too aggressive. Just the early stage companies that have like a key missing hole in their management teams.
Right.
But it's pretty tight right now. So it's fun. My R&D teams now are working from home. I have a few companies measuring productivity, and they're seeing about little over a 10% improvement in productivity
Huh.
from the R&D teams during this time. So probably some of it is just motivation to want to keep your job and work hard.
Right. Right.
But it seems the lack of commute time is really improving the hours on keyboard for the R&D teams. So I saw Amazon this morning told their white collar workers they don't have to go back to work in the office until October.
Wow.
They have options potentially of going in earlier, but they're free to stay at home till October. And I think it's going to be interesting. I have a couple portfolio companies whose office leases are ending now or soon that are going to go purely virtual for a while. And it's going to be fascinating to watch. The longer the shutdown happens for white collar workers, the more people are realizing you can get a lot done over Zoom. And if these anecdotal data points of productivity continue, I think it's going to be great news for places like South Bend, Indiana, where if 95% of the company's working virtually, it's a lot easier to be anywhere.
Yeah.
And so it'll be interesting to see it. The more this is a V, I think things will kind of go back to normal and people won't have big habit changes. But if this extends a little bit, I think you could see much more virtual operations in the startups. And then I think it's going to be great for emerging tech hubs like South Bend and Indy and Bozeman, Montana.
Yeah. You said a couple of things really interesting. I know for me personally, that lack of commute time has been really impactful in terms of how much I can get done. Now, I will say that after so many Zoom meetings, you get a little burned out, but it's been amazing what we've been able to get done. So let me just extend that a little bit and ask you, do you see long-term implications emerging? I'm kind of getting to the question bank, by the way. So if you're on the call right now and want to start asking questions, I'm going to start going through those and asking Tim the questions that you have. And this is one of those, which is, what are the long-term implications you see emerging from the current pandemic around the way that early stage startups are formed, built, operated? What would new normal be if this lasts longer? You mentioned one, probably a lot more remote work, a lot more disparate kind of working teams. But what else are you seeing?
Yeah, I think the other thing one of the other big things is to watch is business travel.
Mm.
We've really been in a habit of needing to do a lot of things in person to get business done, even though the tech tools have gotten way, way better over the last 20 years. I think that it's going to be interesting to see if an Amazon or a Microsoft or some of the big Fortune 500 companies take a fundamentally different approach to business travel. If business travel becomes an exception versus the rule to go to big conferences all the time and business meetings, could have massive implications long-term for the travel industry, because travel is very much funded by those high-cost business class tickets.
Right.
So I'm hoping from an environmental and an ESG and an impact standpoint that some of that business travel becomes less the norm and more the exception. I think quality of life for families is getting better for people. I think they're really enjoying being around their kids more and their spouses more. They'd rather not. I think most would rather not have to teach their kids. So hopefully this is good news for teacher salaries, as people respect teachers so much more given the tough job they have. But I think between the remote work potential and if business travel becomes an exception, to me, those are probably the biggest things I see. Huge potential implications on the travel industry, and then huge potential implications for commercial real estate and residential real estate. So, the Bay Area. In the Bay Area, we have 1 million more jobs than housing units in the Bay Area, and that discrepancy creates massive difficulty on the vulnerable. The highest homeless rates in the world, and service workers have to live far away to be able to commute in. I think it's gonna be really interesting to see if companies, like Microsoft, that are trying very hard to get they have very specific goals for ESG and for environmental impact. Those things get a lot simpler if you do more virtual and make business travel much more of an exception. Those are probably the biggest ones I see coming up that are going to have a chance to have this be disrupted. I think universities and academia is fascinating.
I do too.
I think a lot of the weaker schools are going to go away. There's this interesting thing I'm sensing in my 3 college daughters that they're okay with online, but they don't really learn. They feel like they don't learn as much as in person.
Right.
A lot more professors are getting used to teaching online and getting exposed to something that's been out there, but it's not been something they've tried before. But my kids really want the in dorm experience. So as much as kids are super connected and they can FaceTime anytime they want with their friends, there's nothing like that rite of passage of being in the dorm. So the long-term implications for college is it could really boom, cause a boom in the in online education, or could set it back dramatically as people tried it and said, you know what, it's not as good. So so much unknown. What's fun is every startup usually has a really good answer for the why now question.
Right.
Something's changed that's caused an opportunity for a startup now versus 5 or 10 years ago. And when there's change, there's lots of pain, usually for the vulnerable, which we have to be attentive to. But where there's change, there's also often great startup opportunities.
Yeah. In fact, that leads into a question. We have a listener who asked, do you believe that the innovation that will be born out of this recession or out of recessions and depressions, is that due more to this societal status quo shift, or is it emerging white space for entrepreneurs to kind of now think about new things, or is it both? I mean, how do you see that?
Yeah, I think it's both. Where there's change, there's opportunity. Where one tech innovation happens, it often opens up new problems and unmet needs that have to be solved as a result. I think it's fascinating in sports, some of the stuff that NASCAR's been doing with iRacing, and some of the innovations around esports. It should have they've been getting really good ratings. So it'll be interesting to see if esports comes out of this with a lot more interest in the NCAA as they try to find a way to cure the revenue ills they had before COVID, let alone after. Clearly, people are craving in-person access and community, but some of the traditional ways we've done it with 75,000 people in one stadium.
Right.
How does that come back? U.S. domestic travel, probably a good time to own an RV and have it in the in the rental pool. Is I think you're going to see, just like after 9/11, you had a lot of people taking domestic trips versus flying off to Hawaii or to Europe.
Right.
So I suspect if things reopen, you're going to have a boon in sort of domestic. And then it'll be interesting to see if people's attitude shift and behavior shifts. If you don't have any real need for much on the material side for 3 to 6 months, does it change how important those things seem to be before? So all kinds of, I'm shocked, frankly, that the stock market is where it is. It seems way overbought to me. Long term, I'm in the Buffett camp of never bet against America. So best to let it sit and let it ride. But
Right.
in the short term, man, with entire industries shut down, Delta Airlines said they were losing $100 million a day the other day.
Right.
And trying to get to 50 million loss a day. To have big sectors like that of the economy sitting idle, and yet have the markets barely reset will be interesting to see where that all plays out. But who knows? The answer is who knows. Great news is founders are innovative, and if there's an unmet need, there's usually 5 to 10 founders trying to fill it.
Yeah.
So it's going to be fascinating to watch over the next year what new unmet needs emerge, and what founders, what business models come in to try to solve those.
Yeah, absolutely. You just alluded to something that I think is really fascinating. I was reading about some changes in consumer behavior of the Chinese. It was focused on the Chinese, and that it was talking about some companies that are reliant upon these big populations returning to major consumption models. And that in fact, maybe people are going to reconsider the way they consume things, right? I mean, one new normal might be that we don't consume nearly as much stuff as we used to. How do you see that? Are you seeing big changes potentially in just the consumer behavior?
Short term, we have massive change, but that's more mandated
Right.
than new habits. I think the longer this goes on, the more the habits can change. I think the travel industry, I've been surprised that travel, if you look up flights to Hawaii over Christmas, they don't have the huge sales on that they normally do when they want to cause human behavior to change again. The marketing engine of the Global 2000 is so incredibly effective at driving consumptive habits that there's probably going to get back to the old way, given the amount of expertise and dollars that go into convincing us that we absolutely have to have that family trip, and we have to absolutely have that new Wave Runner or car.
Right.
So that engine, there's a lot of parties who are eager to see the old consumption model get back the way it was. So I suspect long term it will be close to that, but it certainly is an opportunity for consumers to rethink, especially in light of climate issues, as to what do they really need. Like I'm on airplanes, many times a month,
Yeah.
For a mix of business and fun, and I got to say it's awfully nice to be home every night for dinner with the kids.
Yeah, absolutely. Do you have any examples in your portfolio of companies that are actually pivoting or making a successful pivot during this time with the new opportunity, and can they sustain that after the pandemic is over?
Yeah, I don't have anybody that's making a hard, 180-degree shift in the portfolio yet. I think it's mostly a function of those who are essential are just growing like a weed and running under that, like the sun baskets. My GetLabs guys who are about to launch home lab deliveries, that's an interesting one, because that's a company where we probably would have been fairly careful and cautious about growing. Start in one market, improve the unit economics, and then expand to markets 2 through 5. That's a company where we might have an opportunity to shift to, very COVID-centric testing, and try to get to many markets much faster.
Yeah.
So, it's more of a scale of focus rather than a 100% shift.
Right.
So far, I've heard of I've been pitched lots of startups with COVID specific business plans. But you got to really look carefully at those as to whether
What's sustainable, right?
is it sustainable or not.
Yeah. What about businesses that you have in your portfolio that are selling primarily to government? Do you see government customers, and do you differentiate between federal versus state and local in terms of their ability to kind of skate through this and pay their bills and make decisions, et cetera?
Yeah, I've been pretty light on companies that focus on selling to government. I've got an AI company that sells a ton to, defense related stuff. But I've avoided it for the most part. Some folks have had tremendous success selling to federal government. Some occasionally have success selling through, state and local governments. I've never found my best companies to have those buyers as their best buyers. I like for-profit companies as my buyers. And I like companies that affect the revenue of those for-profit companies, because if you affect revenue for a for-profit company, you get attention if you move the needle for them materially on revenue. So I don't have that much exposure on the government side. It always feels a little bit boom or bust in that area. So if you're doing something for FEMA, these disasters happen and Congress issues massive budgets, and there's these short-term windows where you probably can make a ton of money.
Yep.
I've never wanted to rely on companies that have regulatory barriers between them and their customer. And I've never wanted to rely on a non-profit driven buyer. That's why I've never, none of my companies focus on selling to universities, for example, because universities are just not great buyers of software because they lack the urgency of a for-profit company.
So let me ask you a question from this is a female founder in South Bend who had a very successful, yeah, exactly, had a very successful Kickstarter campaign and was identified by Amazon as a strategic brand partner. What's your take on the effectiveness of strategic partnerships, especially for young companies? When should they get engaged with them? How should they get engaged with them? And especially as they're trying to protect their own brand value while they're also working with a strategic partner. Do you have any insight for this founder?
Yeah. So if you figured out a way to have Amazon help you deliver revenue, you're doing better than 99.9%.
Right.
Both Facebook and Amazon, tend to have their hand out to try to get to let you have access to their distribution. So it all depends on what that brand partnership means. So Amazon, there's certain buckets of startups where Amazon and Google and Microsoft will give you 120,000 or 150,000 of Google Cloud or AWS credits. That's something that Idea Center might be able to get in the mix of. It's pretty nice if you can get all your startups, all my startups that I fund get access to those programs. So that's free money. If you're going to be spending money on AWS anyway, why not get the first 120,000 free?
Right.
So those kind of deals are good. I haven't seen Amazon or Facebook able to help you with distribution unless you pay real money.
Yeah.
And so you typically have to raise money to be able to afford that, to pay the Facebook ad bill to get distribution. Now it works well on Facebook for a lot of my companies. So probably 80% of the capital we raise in growth companies turns right around and ends up being paid out to Facebook for customer acquisition cost. Microsoft's got some cool programs going now. If you get funded by M12, their venture arm, you can have their sales reps get full quota credit for selling your revenue. That's been yielding for some companies. But on Amazon, it's been more, they're going to take a big cut of your revenue if you sell on Amazon.com. And then in order to get real growth there, you gotta pay their ad team fairly significant money to be featured on the first page. So it hasn't been a way to reduce costs. Kickstarter's awesome as a source of customer demand. You just got to be a little careful. A lot of times, what Kickstarter people will buy is the exact wrong signal for what will be mainstream desired in the world.
Interesting. Why is that? That I've never heard someone say that before. That's really interesting.
I think it's just an eclectic group of buyers there.
There's kind of a bias towards, and that's interesting.
So, I had one company that had massive success on Kickstarter, and they treated that, and investors treated that as a big signal. And then when they started to go mainstream, nobody outside the Kickstarter community wanted it. So they ended up pivoting. It's a great story. It's a unicorn now. It's a company now. It's called Zipline. So if you go to flyzipline.com, you can see what they're building. But now they're building big product delivery drones. And we're live in 3 countries and hopefully get FAA approval to be live US wide. But we're delivering medical supplies in 3 different countries now, saving thousands of lives a month. And that started as a company that was making little personal robots.
Uh-huh.
So you'd put a smartphone or an iPod on top of this little robot they made, and you had this fun little robot. And the Kickstarter folks loved it. And then the CEO was like, struggled to find lots of demand outside of Kickstarter, and then realized he wanted to try to make a big difference in the world. So he took all that combination of software and hardware and machine learning capability on his team and pivoted to life-saving drones. So pretty fun. Now it's a unicorn, not a liquid unicorn yet, not an exit unicorn, private unicorn.
That's awesome. That's awesome. Here's another question. In your mind, is there an advantage to being a B2B versus a B2C? Which of these would be the better place to be, or no difference? What do you think?
If you have good unit economics in B2C, life has gotten really, really good for you. So the cost, there's people are probably spending twice as much time on Facebook since they have all this additional time at home.
Additional time, right?
And then there's a bunch of bidders who are sitting out on Facebook, as they're trying to conserve cash. So for a number of my companies that use Facebook as a channel for acquisition, the cost of customer acquisition has gone down dramatically in the last 6 weeks, and we'll see if that holds. Not clear what the implications are for Facebook, because while the ad rates are lower, the cost per clicks are lower, the number of ad views may be much higher. So hard to predict what the implication for Facebook stock is. But as a B2C company, if the last 30 days you've gotten really good CAC doubling times, you're in a great position to double down and do more and do much more of that. On B2B, it's a tale of 2 types of companies. Are your customers essential, or are they not? And so it's a very mixed bag in my portfolio. Some are having everybody's seeing the pipeline lighten quite a bit. Some are seeing new deals close much more quickly than others. So it seems to really come down to how disrupted were your existing customers. I have one of my companies that has some technology for optimizing TV advertising. And they've seen a massive increase in demand in essential industry companies, and then their customers in travel have gone to zero. So on a blended basis, they're doing okay. But in general, the best place to be right now is B2C. If your CACs over the last 30 days have been good, that's the best place to be in the world right now, because you can double and triple and 10x.
Yeah, especially in those essential industries, right? I mean, if you're talking food delivery or something the customer needs at home, I mean, that's an amazing.
It's been awesome. Yeah.
Let me ask about manufacturing. This kind of comes to the other side of this. What do you see any long-term changes in terms of efforts to move manufacturers towards more automation, more AI, more machine learning, and maybe less reliance on overseas supply chains, that prove themselves to be incredibly intricate, incredibly interdependent? Do you see changes there at all long term?
Yeah, this is one area where you'd hope to see a little bit of regulation.
Yeah.
Um, lightweight regulation can be a good thing. It's always hard to get it just right on regulation side, but having our drug supply chain be as optimized for cost as it is, with lots of implications for reliability, hasn't I don't think is necessarily the best trade-off.
Mhm.
But companies who are focused on just optimizing EPS will make those decisions. So you'd hope there'd be a little bit of re-insourcing or onshoring, whatever the term is you want to call it. You'd hope to see a little bit of that happen. There's an interesting trend line happening now where these robotic arms that are used in all kinds of applications are getting incredibly cheap now. They've gone down something like 10x. They're 1/10 the cost they were 5 years ago.
Wow.
So China is the manufacturing hub, and they've aggressively used robotics in assembly. And it'll be interesting to see. There's some companies that are starting to use them in service industries. So as DoorDash and others move to dark kitchens or cloud kitchens, do you have the same number of hourly workers working in there, or do you have some of those functions done by smart vision and ML software combined with these new low-cost robotic arms? Lots of interesting implications there if you can automate more of this food prep now that more of it's being ordered online.
Right.
So I haven't found a way to play that big trend line, but there's definitely a massive trend. If you take the basic robotic arm and reduce it in cost by 1/10, now there's a whole bunch of new use cases that weren't cost effective prior.
Right.
So we'll see a lot more of that. It'll be interesting to see if Foxconn was talking about coming to the U.S. under political pressure. Do they actually get aggressive now and come back?
Mm-hmm.
So I think a little more thoughtful on not just cost, but resiliency.
Yeah.
Would be great. I don't hold my breath that companies will do it on their own. So hopefully there's just a little bit of regulatory incentive to do that. And I think it could have, good long-term implications.
Yeah. That question has been a big one of big interest for Northern Indiana, where we have so many manufacturing companies and which have resisted a lot of these technological changes for a long period of time. And it'll be interesting to see if this impacts them in a positive way in terms of moving towards more automation and digitization and other things like that.
It would be great. I think the South Bend Elkhart's sitting on such a huge opportunity. I've said it to a number of people, but if I'm in economic development in that area, I get a team of people on the ground in Palo Alto talking about what the capabilities are and learning what the unmet needs are.
Yep.
I think there's just tremendous opportunities. I mean, just take RVs, the ability to bend sheet metal for housing, and all the implications, when there's 1 million more jobs and housing units in the Bay Area, and everything's starting to shift to this modular construction where you're doing factory-based production of these Lego blocks and then doing on-site assembly of condo buildings and office buildings on site, kind of assembling the Lego blocks on site. What a tremendous opportunity for Elkhart that they haven't been jumping on yet.
Right.
There's only so many RVs people need. But between, there's some really good innovation going on in pallet homes for the homeless. That's a no-brainer. Tiny homes, another no-brainer. And then this modular construction. Somebody could really could do well do really well financially, but also do a lot of good for the vulnerable by getting into the manufacturing, turning housing into a much more manufactured product. And there's some startups working on it and some software companies in the Bay Area and some other companies, but man, Elkhart and South Bend sitting right in the heart of being able to do that. I think the other area for the homeless that we clearly have to fix and the vulnerable is the food supply chain. When farmers are throwing away their product, they can't get them to market.
Yeah.
And there's 42 million people hungry in the US every day, and probably triple that right now with, we just can't rely on this separate supply chain we've built for the vulnerable. I think a little bit of technology applied to some of the world's best supply chains, like what McDonald's has and Kroger has and Walmart has. If you do a little lightweight tech layer on top of that to match the hungry with food in the best supply chains versus trying to replicate the supply chains, I think there's probably for-profit startup opportunities there, but there's certainly an opportunity to whiteboard and say, hey, now that all these different tech platforms exist, how do we solve basic areas like food and shelter in a different way now that tech exists? And I think we could come up with some really, really creative solutions.
That's great insight. You
Better.
probably saw that Washington's trying to get rid of a billion with a B, pounds of potatoes.
It's crazy.
It's crazy just what's happening.
Yeah. So, I hope there's going to be innovation there. Uber and Lyft, if you think about Uber and Lyft, they created this very thin tech layer. It's one of the easiest pieces of software to ever build to match people who need a ride with people who have a car and need a little extra money.
Yep.
Imagine if we did the same thing using tech platforms to connect those who are hungry.
Yeah, with potatoes.
With the food that's a mile away from them at McDonald's and Kroger and 7-Eleven.
Sure.
A really thin tech layer with the right corporate philanthropy focus from some of those big guys.
Yeah.
McDonald's is down dramatically in demand at a time when hunger is up dramatically.
Yeah. No,
they have plenty of capacity. They source more potatoes and meat than anybody else. And
that's why there's so many potatoes on the market, because McDonald's isn't sourcing them anymore, right? So, yeah.
So imagine I could get a hunger app when I'm hungry, get a virtual debit card from Visa, go through the McDonald's drive-through and order my healthy Happy Meal.
Yeah.
And McDonald's charges food costs to the Gates Foundation or the Zuckerberg Foundation.
Yeah.
McDonald's food cost, I think, is about 30 cents for 800 calories to keep somebody full for a day. 30 cents times 42 million people, it's 4 billion a year. We spend over 100 billion a year on food insecurity, and yet 40 plus million people are hungry every day.
It's true. That's true.
So I'm hoping we can come up with some simple technology approaches that can do that matching. It's kind of crazy that McDonald's is probably within 1 to 2 miles of 95% of those hungry people.
Yeah.
Right now they have extra food and capacity, and yet the hungry are walking or driving past 3 McDonald's to get to the soup kitchen or the food bank, only to find that they've got an 8-hour line. It's really crazy that was probably the right answer 20 years ago, but now that you've got all these tech platforms, can we whiteboard out and say, hey, here's a new way to do these things? So hopefully we'll see some founder innovation coming in some of these areas in the future.
Yeah, absolutely. Well, Tim, this has been such a privilege to have you here. Thank you for taking the time and being with us. One last quick question for you. We had a lot of people who want to obviously get in touch with you. And while I don't want to encourage a direct contact, I'll ask this question. How would I, if I were a founder right now, best get in touch with VCs like you? How do we make that connection most effectively? You're looking for the best deals. They're looking for the best funders. How do we do that?
Yeah, it's incredibly inefficient today.
Yeah.
So any donor, I'm always happy to take an email and try to be as helpful as I can. So I'm Tim at PivotNorth.com. If you want to reach out directly to me, I'll try to at least be responsive on an email to you if I can be. Startup funding in general is a relationship business. As hard as that is for a first-time founder, there's a lot of the biggest risk I take. I can analyze market risk and technology risk and competitive risk pretty easily now that I've been doing this for a long time. But it all comes down to the team. So it's founder. And it's really hard to meet a founder for the first time over the transom, over an email at a demo day, and make an investment decision without any ability to to know that founder, get to learn about what that founder's skill set is, to get trusted references from a founder.
Right.
So it makes it such that once you've had a successful startup, it's 10 times easier to get funded on the next one.
Yep.
But it makes it that much harder, and you got to really rely on your smarts and goodness and grit as a first timer to get there. So in general, you want to look for, where do you have folks who know the recipe, i.e. they've been a startup founder before, or been through a high growth startup before, and then they've funded founders who've had success. So I call it the recipe. So if you've been through a high growth startup as a employee, there's a whole bunch of stuff that you know how to do that nobody can really explain it to you until you've lived through it.
Right.
So if you're a student at Notre Dame and you want to get into startups and VC, go work for, typically you go work for a big company, big tech company, and then you go work for a high growth startup, and then you learn the recipe, and then you go found your own. And then once you've had success as a founder, then you typically start investing, and some become VCs. Right. So if you're a first-time founder, what you want to look for is who in your sphere of influence has capital. That's awesome if they do. The wealthy aunt or uncle is a great way to get started. The former boss, etc. And then if they have money and they have the recipe, that's gold. So you really got to work your way. So if you look at what Mark Zuckerberg did, he had never done a startup before. He didn't know what he was doing. But he found Sean Parker, who had the recipe, and then Sean Parker was his founder coach.
Right.
So you got to find that founder coach, and oftentimes it comes with some seed funding. But if you try hard, you can usually figure out how to get somebody in your sphere of influence will be able to coach you a bit. So at Notre Dame, we have a big advantage now because we've got, I think it's numbers now 43 Notre Dame alums who are VCs.
Yep.
Over 100 Notre Dame startup founders and senior execs. And then we've got the Idea Center helping coordinate a ton of stuff. So it's now easier than ever if you've got a Notre Dame connection to get time with folks who will spend more time with you because of the Notre Dame connection. And then you just got to go from meeting to meeting to meeting until you find that perfect fit where you find somebody who believes what you believe and then is able to get comfortable enough with you as a founder to write that check. But I'd spend more time building relationships than high throughput, emailing random people.
Yeah. No, it sounds like that grit and relationships is really the way to.
It really is. It really is. It's. I don't think I've done a deal in 15 years where I didn't either know the founder or that the founder wasn't very well known to somebody that I know really well and be able to really vet them. Well,
Tim, this has been such a pleasure to have you on. Thank you for taking your time, sharing your wisdom. And I'm sure that everybody is incredibly grateful. I know you can see some of the comments of everybody being very thankful for this. We will post this recording on our website at ideacenter.nd.edu if anyone would like to go back and review it. And if there are additional questions, we'd be happy to take those as well via email or remotely. So again, thank you so much for your time, Tim. Keep your family safe, and really excited to see you hopefully again at a football game someday in the future, but if not there, someplace else.
That'd be great. Stay safe. Go Irish.
All right. Go Irish. Thank you.